Hello everyone, this is CA Pratiksha Pai
And I'm CA Sanket Naik.
and we welcome you all to the Fintelligent Investor series by Rupee Financial Services. We thank Rupee Financial Services for having us on this series where we are going to learn about the financial world. So starting off this series today, the first topic today we'll discuss is about PPF, that is Public Provident Funds. So PPF, what is PPF? PPF is nothing but a long-term savings scheme. This scheme was introduced as its main objective was to promote making small savings and provide returns on the same. This PPF, what we say, this is a tax saving, security and return scheme. That means the amount that you invest in the PPF scheme is allowed as a deduction while doing your tax computations. Secondly, whatever interest you earn on this investment, there is no tax on such interest. And thirdly, when you finally receive your maturity amount, there is no tax on such maturity amount as well.
Yes, so I'll brief a bit more about the scheme. It was launched in 1968 by the Finance Ministry, National Savings Institute. And the rate of interest keeps changing, but at the moment it is at 7.1%. This can be changed by the government and it remains the same irrespective of where you open it, whether a bank, post office, private bank, PSU bank, it's all the same. And the tenure is 15 years normally from the time you open the account, so it's a long-term scheme. And there is an option to extend this by another 5 years. And you can start with a very small amount of even 500 rupees, but the maximum amount which you can go about is 1.5 lakhs in a year. So if you want to do more than 1.5 lakhs in a year, it can't be done in this scheme. And the maturity amount, what happens is it depends on how much you invest on a yearly basis, and you can make investments on a regular basis. But you just have to make sure that at least one deposit is made during the course of the financial year.
So now let us see who is eligible to open this PPF accounts. Firstly, only a citizen of India is eligible to open this account. So it should be a citizen. We are not talking about the residential status right now, though of course NRIs are not eligible. So it has to be a resident citizen. So if you are a resident but not a citizen of India legally, then you cannot invest in this scheme. So firstly, you have to be a citizen. Secondly, it should be an individual. It cannot be any other type of legal entities which can open a PPF account. And thirdly, again, you shouldn't be an NRI, which means you shouldn't be a non-resident Indian. So to open a PPF account, you should be an individual who is residing in India and who is also a citizen of India. So if you are a citizen but not resident in India, then you cannot open. If you are residing in India but you are not a legal citizen of India, even then you cannot open the PPF account and you cannot invest in this scheme. So the eligibility is very simple. It's an individual resident citizen who can open a PPF account and invest in this scheme.
So how can we go about it? It's a very simple process. So you can go to any post office which is the most widely available irrespective of whichever city you are in or whichever town or village you are in. If not, you can always go to a nationalized bank, and nowadays you can always do it online as well. There are options where you do not even visit anywhere. You can do it with select private banks as well, where they have also launched this. You can do it through both offline or online mode. And typically they will ask for an ID proof, an address proof, and a signature related some proof.
So first let us see what are the features of PPF scheme. In PPF, a minimum of 500 rupees per annum and a maximum of 1.5 lakh rupees per annum can be invested. So what this entails is that even for the common person who can maybe afford to put in just 500 rupees per annum also, this scheme is catering even to that, as well as to the other extreme level where a person can invest around 1.5 lakhs per annum. Also, when someone has a PPF account, if in some year due to some contingencies, if you are not able to even put in 1.5 lakhs, it is advisable to at least put 500 and keep the account running, and it is mandatory, right? It is mandatory
yes,
to
you need to make at least one transaction.
At least one transaction of a minimum of 500 rupees, and to keep this account running. So this is one main feature of this account. And secondly, how many transactions can you do in a PPF account? So per annum, a minimum of 1 and a maximum of 12 transactions can be made in your PPF account. So this is very nice, where people can do a monthly planning and invest, because if it's 1.5 lakhs, maybe at once it is difficult to invest, but around 12,500 per month you can plan, and you can invest in this scheme. Also, next is the tenure. So a PPF has a minimum tenure of 15 years. So as I told in the beginning, it is a long term saving scheme. So what happens is there is a 15 years of lock-in once you start investing in this scheme, but this is very this is very attractive scheme because of its compounding interest, right?
Yes,
exactly. So this account, it has a minimum tenure of 15 years, and after 15 years, if you want to extend the scheme further, then you can extend it in a block of 5 years each. So after 15 years, once you renew, or once you extend, you can't tell that I'll extend it till the 17th year. You have to extend it till the 20th year. So that is how it works. Fourthly, eligibility, which we already saw, that a resident, Indian citizen, individual citizen, resident, these three have to be fulfilled in order to be eligible to come into and invest into the PPF scheme, right?
Yes. So as we said earlier, so what is the minimum amount involved? So you can start with as low as 100 rupees for opening the account, and a minimum of 500 rupees per year should be made. So it works on a compound interest basis, not on a simple interest basis. What happens is the interest gets accumulated to your principal sum, and in the following year the additional contribution, and on this amount again interest gets calculated. So this is a very attractive product because there are not a lot of products which offer compounding. Most of them are usually working on simple interest basis. Now, can this be done jointly? No, there is no option to do it jointly. However, you can make a nomination. And what about the risk factor? Is there going to be a risk factor? Well, may not be, because considering that this is a Government of India backing in this directly or indirectly, but I don't think this is something which any citizen should concern about. There may not be any risk involved in this product. So people who have a very low risk appetite, who are scared to invest in the stock market or mutual funds or ULIPs or what, many of these new products, this is a very safe product. Of course, it's a long-term product and the returns are guaranteed. However, the returns depend on whatever is announced on by the government. So what happens is the returns which you have got in the first year may not be the same which you will get in the 15th year. The rate of interest can keep varying, because in the past there used to be a very high rate of interest. Nowadays the rate of interest has dropped a bit, but still among the existing products it's a very good product when you look at the rate of interest.
And especially looking at the Indian society, Indian way of society, we in our families we have this wherein we have to save for the higher education of our kids. Maybe someone wants to save for their retirement, and especially kids' marriages also in our society. So a lot of things where Indian families have to plan and save for. So this is a 15-year scheme. So there is a lot of time to really plan and save for all this. And as you said, definitely this is a scheme for people with low risk appetite, because you may feel that the return is just 7.1%, which is the return right now. Also, what happens here is there is the government backing for this scheme, because this scheme is made to promote savings. So there is a government backing, and you can be assured that you will get your interest and your maturity amount, plus no taxes.
Correct.
So all in all, this is a very low risk appetite. Whoever has a very low risk appetite, whoever wants to ensure safety of their money on a scale of 1 to 100, how much would you rate this? 100, right? You will definitely.
You can, except for the long term factor, but that is an advantage, because when you are investing in a lot of products, the longer you stay, the better return which you get. So
correct.
One thing which you need to keep in mind, the returns are guaranteed. Whatever rate is prescribed, you will get it, but the same rate may not be there throughout the tenure.
Exactly, but you will get even your invested amount plus plus interest,
yes,
and also a compounded interest.
And also, one we should keep in mind, when we are saying 7 point some this percentage, for example, when you are comparing it with some other product, let's say some other FD product or something, you may feel, I may get 5% or 6% in some FD somewhere, which is not having a lock-in. Why should I do this? But you should keep in mind, this 7.1% is tax-free. So the way you have to make a comparison is, the 5% or 6% should be deducted, adjusted for the taxes which you owe. So let's say it's a 5% product. So 30% tax will result in a 1.5% going in that. So what will remain is only 3.5%. That is what you should compare with the 7.1%, because here there is no tax involved in the product.
Correct. Also, one more important feature of PPF scheme is the loans against your PPF investment.
Yes.
So do you want to tell about this?
Yes. So you can always take a loan, but this is only prescribed for a temporary period. So between the 3rd year and 6th year of opening of account, you are eligible to take a loan, but the rate of interest is just 1%. I don't know. That's quite hard.
That's really
yes.
That's really good. I think it again promotes a lot more people to invest.
Definitely.
More.
Right. And one more thing. Now we were mentioning earlier about the deduction of Section 80C, wherein you get deduction up to 1.5 lakhs. But do keep in mind, there is no additional deduction for PPF as such. It is the overall part of the 80C 1.5 lakh. Correct. So please keep it in mind if you are having already other products like insurance and all these things. If you are doing it only for the purpose of getting an 80C deduction, please keep it in mind that everything is clubbed together 1.5 lakh, and anything which you do over and above 1.5, you don't get any extra deduction as such.
But even other than tax point of view, I think this is a very good.
Yes. Deduction is one aspect. Secondly, the interest rate exemption is anyways going to be there.
Exactly, and also the safety of money. The money is growing in a very systematic manner.
Definitely.
So that is there. Now let us look at the tax benefits of this PPF scheme. So as I told in the beginning, this is a EEE scheme, which means exempt. Okay. So why is this called an EEE scheme? Because the amount invested, what you invest every year, that attracts a deduction when you are computing your taxes. Then the interest earned on your investment, that is tax free. And also the maturity amount that you get at the end, that is your investment plus interest, whatever the maturity amount you get, that too is exempt. So this is an EEE, exempt scheme. So this is why even other than tax, this thing also, if you keep, now let me ask you, if a person tells that I want to invest in FD, exact amount, okay, 1.5 lakhs. If he takes a loan against FD, what would be the interest rate?
It would be +1 or +2
above the FD interest.
Rate of interest on the FD.
Correct.
And also you have to pay tax on the interest which you are getting on the FD.
And the loan will be +1%.
Yeah.
So here, even if keeping all the tax benefits aside, also if you are just investing and taking a loan, it is that is also good, right?
Yeah, see, what you have to keep in mind is this is something which you should keep in the long term nature. So you just invest there and you can forget about it and just keep investing, and only on the maturity date you will see that you got a very good sum of money.
And it's compound interest. So it compound interest, they say, right, a person who knows who understands compound interest earns it, and a person who cannot understand compound interest ends up paying it. So that is why I think that is one good thing. And also I feel that youngsters nowadays, people start working in the age range of 22 to 27. So these people can maybe start investing for their kids' future education, higher education and all that. If you're starting at a middle age like 40 to 45, that you can plan that amount for your retirement.
Correct,
right?
Correct.
So any age group this really caters to.
Yes, you can maybe in the initial years start with some lower amount, and as and when you can afford to put more and more, you can think of putting up the entire 1.5 as well.
Correct. So I just wanted to ask, up and above 1.5 lakh, I don't think there's that interest, right?
You can't, they won't accept anything above 1.5.
Okay.
So that's the maximum which they allow.
Oh, okay.
And see, many people, what happens is people who are in employment, many people will have provident fund net, wherein their employer will be contributing to provident fund and their portion of salary goes to PF as well. But many people who are not in employment, they feel that, I don't have any such option. But PPF is a very good option here, because even if you're in business, professional, or having rental income or any kind of income, you can always invest in PPF, and end of the time many people feel, he's retiring, get a very big sum of money. But you should keep in mind, it's because they have contributed over the years that he's getting that sum of money. So you can also do that. Even if you are not in employment, by investing in products like PPF and get a corpus, and like Pratiksha said, it could be for retirement or for higher education.
Yes, at any age.
So it makes a lot of sense.
And also I think really people who are having their own businesses or startups or own working and getting their own income other than employment should definitely look into this, like PPF, NPS. We should make another video talking about NPS, which is the National Pension scheme. So actually I think this video should be viewed by people who are, of course the employed should watch it, but really this should be taken up. People who are having own businesses should really think about investing in schemes like this, because all said and done, in employment there is still some security. In business you never know, something happens in the market and the business goes up and down. So these kind of social, and we don't have this social security what they say in the US, right? So we have to create our own safety nets. Correct. And this is one of the best ways, right?
Definitely. And even people in employment now, over and above the PF, if you still want to create more corpus, this is all, you can also do that by investing in PPF.
Correct. Because during when you're getting a salary, maybe you don't want to suddenly monthly put 12.5. But if you end up saving, you can make up to that 1.5 lakhs, right?
Definitely. Or any lump sum amount, or any amount which you feel is fine with you, looking into your financial position.
Correct. So coming to finally discussing PPF in a nutshell, we can say that this is a good long-term saving scheme catering to a large part of the population, because the minimum is 500 and the maximum is 1.5 lakhs. So it has a very diverse reach. Also, the amount invested is allowed as a deduction. Interest is tax free. Maturity amount is tax free. So really, it is a great scheme backed by the Indian government.
Definitely, there are very few products which offer EEE.
Correct.
And also which have guaranteed returns and backed by the government. So I think it may be one of the very few products which are offering all these features.
Okay. And the best thing is that it can also be renewed in blocks of 5 years. So if someone at the end of 15th year they feel that another 5 years we don't require this sum, then it's a great opportunity to keep that entire amount locked in, earn compound interest on that, as well as have the option of again investing for another 5 years and maybe getting a really huge sum.
Yes, see, many people may be at the very end of their career, or they may just have 5 or 6 years left to retirement. In such case, it may not make sense in now starting a new PPF again. It will entail a 15-year lock-in. So this 5-year window is a very good option in such a case, wherein you can just extend for 5 years, and by the time your retirement, or let's say even if you're in self-employment or in any kind of professional position, you may have something in mind that beyond this I may not want to work at the same level, or I may want to wind up. So you can, keeping such things in mind, extend by 5 years.
Yeah. So thank you everyone for watching this video with us about PPF. If you have any further questions about this scheme, you can please let us know in the comments below.